Okay, thanks for joining me. Today I'm going through June 13 ACCN1. It's just a basic income statement and balance sheet. It's question 3 on this specific paper. But yeah, so it's basically I'm going to do my workings, do the income statement, and then just do the balance sheet, and hopefully it balances at the correct figure at the end. So it's just following a method, really, in a sense. So working 1, inventory at the 31st of March 2013, which is when the year ends, at the top. It was valued at 24,600, so that's just our closing inventory, and that is 24,600. Okay, on to working 2. An item of equipment purchased on the 1st of April 2014, so that's within our financial year, for 1,200 has been incorrectly included in the general expenses. So if we assume it's been incorrectly included, we sort of have to assume that we've increased the general expenses when we shouldn't have. We've purchased equipment and then we've added it to general expenses, which is obviously wrong. So our general expenses were 5260. And what I'm going to do is just take away that 1,200 to give me 4,060. So if we accidentally increased our general expenses, it means we forgot to increase our equipment in the original entry into the journal, in a sense. So equipment. So it's just going to be the original cost figure, 18,200. I'm going to add on this purchase we've made of 1,200. So that's 19,400. So on to working 3. So this deals with the equipment a bit more. Equipment is depreciated over 10 years using a straight line method, so it's going to be the same amount of depreciation every year. The estimated residual value of all the equipment is £400. So after 10 years, we expect this equipment to be worth £400 in a sense. That's how it works. So let's work out what the depreciation is per year, and then we can work out what the equipment is worth now, which we can put in our balance sheet. So depreciation. So brackets, I'm going to do this 19,400 here. That's the cost figure minus my residual. Close the bracket and just divide by 10. So that gives me now what amount of depreciation I'm going to charge every year to the equipment, which is 1,900. So that's going to go in my income statement as an expense. So now we can work out what the net book value is of this equipment. So I'm just going to write equipment, and we'll just put net book value in brackets. So we're going to take our cost, 19,400, minus the depreciation has already happened up until this year, so 7,280, and then take away the depreciation for this year because we're doing an income statement at the end of the year, so we need to include the depreciation for this last year we've just been into, 1,900, and that brings us to 10220. So that's the figure that will go in our balance sheet in the non-current assets section. So, point 4, the annual rent payable on the business premises is 19,920. 2 months has been paid in advance, so prepayment, at the 31st of March 2013. So that's just simply the date which we're drawing up these financial statements. So let's calculate the amount of the prepayment first. So prepayment. So this is a non-current asset right now. So 19,920 is the amount we've paid, and 2 months is paid in advance. So it's 2 over 12. 12 is the length of the contract. It's annual rent, 12 months in a year. 2 months is prepaid. So the prepayment is just that, which is 3,320. So now we've calculated this prepayment, we need to decrease the amount of our rents and rates in our expenses, don't we? Because we've paid some of the expense which isn't relevant to this financial year. And what we want in the income statement is what's relevant to this financial year, not the next financial year. So what I'm going to do is draw up my rent and rates. So my rent and rates were 28,900 in my balances. I'm going to take away this amount of prepayment. So 28,900 minus 3,320, and that's going to give me 25,580. So that's my new expense figure. Working 5. Rates of 3,240 have been paid for the 6 months ending the 31st of July 2013. So 31st of July 2013 goes past our 31st of March, doesn't it? So it's obviously going to be a prepayment. We've paid in advance. So how much of this is a prepayment? Well, we need to count how many months past this date goes to. So March, April, May, June, July. So 4 months of this 6-month contract are, in a sense, prepaid. So it's going to be 3,240 times by the amount prepaid in terms of months over the full length of the contract, 4 over 6, which gives us 2,160. So now we've got 2 prepayments. I'll just add that together in the balance sheet. I won't do it now. However, we made another prepayment on our rent and rates expense. So we're going to have to decrease our rent and rates expense yet again because there's another prepayment. So rent and rates. So 25,580. So we're just going to pick up the figure from the last point and take away the new prepayment. So we'll just cross that out now. We don't really need that anymore. And that's going to give us 2,3,420. Gosh, I just started lashing down my brain. Working 6, a bad debt of 580 is to be written off at the 31st of March 2013. So bad debt is 580. That's an expense plus the bad debt we already have in the balances here. 100 bad debts written off. So what does bad debt link to? Well, it's a bad debt is a trade receivable who can't pay us back because they've either gone insolvent or there's a range of reasons. So trade receivables. So at the end of the year, £8,940 was owed to our company, and we need to take off that 580, which gives us a new trade receivables figure of 8360. This is something that tripped me up when I was doing past papers when I was at college. We don't take away the 100 in the balances because if it's there, we assume it's already been dealt with in a sense. So this 580 here, if we have a bad debt in this additional information here, we assume we need to edit the trade receivables. Whereas if this is a bad debt in here, we assume that bad debt there has been sort of accounted for and been taken away from the trade receivables here. So it's just simple. It's fairly simple. W7. 1/2 of the bank loan is repayable in the year ending 31st of March 2014. That's exactly 1 year after the date of this income statement and balance sheet, so that means it's a current liability. It's payable within 12 months. The remainder is due for repayment after that date, so that's just a non-current liability. So I'm just going to put bank loan. It's 2,450, the amount of the bank loan, divided by 2, give me 1,225. Current liability 1,225, non-current liability. So that's going to go into our balance sheet in a sense. Working 8. Sam introduced £2,000 into the business bank account from his personal savings on the 31st of March 2013. This has not yet been entered into the records. So it's been paid into the business bank account, so we can assume that the bank's going to increase. So where's our bank figure here? We're in an overdraft right now, so it's negative 1860, and we're going to add on £2,000, which equals 140. So we've got a positive bank figure now at least. So Sam's introduced £2,000 from his personal savings. So that's the owner has put in money. So that's capital. So our original capital figure was 11,060. Add on £2,000 gives me 13,060. I've not got much room for working 9 now. We'll slip onto the bottom here. Working 9. A cheque for £410 received from a credit customer has not yet been entered into the books of account. So we've received £410, but we've not entered it into anything. So if we've received money, that must mean our bank's gone up. So our bank figure is once again going to be adjusted. So it's going to be 140 plus 410. That's 550, our new bank figure. So a cheque was received from a credit customer, but it's not yet been accounted for. So well, in a sense, a trade receivable has paid us back, but our accounts don't reflect that in a sense. So we need to sort of decrease our trade receivables, don't we? We need to adjust them because less people owe us money than we thought, don't they? So trade receivables. Let's just move that up so you can see it. So our original, where was our trade receivables? 8,360. We take away this 410, which gives us 7,950, I believe. Yeah. So now we can just cross out that old trade receivable figure. So that's it, really. That's the workings done. Now we need to just transfer all this information into the income statement and balance sheet, and we should be okay. So here it is. They've been very kind for us and actually provided the title for us, because a lot of people lose marks just because it's just one of the things you have to remember. It's got nothing to do with the workings, does it? So first thing in all income statements is obviously revenue. And we didn't adjust the revenue in our workings, and our revenue is 234,520. So what can we take away from revenue? We can take our returns in, 340. We do have returns in, so take away returns in. My handwriting is appalling today. It's quite a disappointment. And that's going to give us 234,180. So after revenue, we have to do our cost of sales, and cost of sales always opens up with our opening inventory. Sorry, I'm having to abbreviate finish just so it makes the video quicker. We're going to add on our purchases, and we're going to take away our closing inventory. So these come to 26,100. We didn't adjust our purchases. No, we didn't. 9,130. I've just lifted them two figures out of here, and the first point in our additional information was that the closing inventory was 24,600, and that brings us to 120,630. So that's going to give us a gross profit of 113,550. And that's that. That's the top half done. There was no returns out or carriage in, but there will be carriage out later, which we'll have to deal with in the expenses. So until then, there's something we need to add to our gross profit. It's an other income. It's discount received. Okay, I'm just going to abbreviate received. 540. So that's going to bring us to 114090. So now I just need to put in all my expenses. I think there's 7 in total, so we're just going to put them all in, take it away from our new gross profit figure, and get our profit for the year, which we'll then put into our balance sheet. So, bad debt. I can start on that line, I believe. Yeah. I'll just list all the expenses actually. Carriage out. General expenses, which we played with in the additional information. Motor expenses, we didn't have changed that at all. Depreciation, we definitely calculated that. Rent and rates, we affected that twice in the additional information. And finally, wages and salaries, I'll just put wages. Sorry I'm abbreviating everything, it just makes it a lot easier for the video. So, bad debt was 680. Oh, I really should put that further away from the expense. So, where my bad debt come from? It came from 680. There we go. My carriage out is 390. General expenses became 4060. Motor expenses we didn't adjust, but that is 4310. Depreciation we calculated per year to be 1900. Rent and rates we first calculated to be as 25580, but then we adjusted it to £23,420. And wages is 42890. That's at the bottom of all the balances they give you. And our total expenses comes to 77650. And the net profit, or profit for the year, whatever you want to call it. I call it net profit because it's easier, it's short to write. 36,440. Oh, so well done if you got that by yourself when you did it previously. If you didn't, hopefully you understand how I got there. But anyway, moving on to the balance sheet. This is just quite a straightforward balance sheet. I've just wrote title at the top simply because with the previous sheets I've been given by the exam board, I've not had enough lines really. So do write title. Don't write title. Write the actual title. Balance sheet for Sam Brady at the 31st of March 2013. But this just gives me a bit more space to sort of do the important stuff that you need to understand. So, non-current assets always goes at the top of our balance sheet. So, I have my equipment. And I believe that's the only non-current asset. It is, yes. 10220. Just underline that to show that it's the only one. Current assets now, after non-current assets. So I have 4. I have my closing inventory, so I'll just write inventory. The trade receivables, as always. Prepayments. There was 2 of them in the additional information we had to calculate. And we got a positive bank figure after taking out of overdraft because we had some capital put in. So the inventory once again is just a closing inventory, so that's just 24,600. Trade receivables after the bad debt and the check paid in 7,950. The prepayments added together become 5,480. The prepayments were simply 3,320 and 2,160. Add them together, you get 5,480, and the bank figure became 550. 550. So our current assets overall become 3,580. Okay, I'm going to go on to my current liabilities. There's loads of different ways of doing laying out a balance sheet. Some people have asked me about it. As long as you like it looks alright and it gives you all the correct information, it doesn't look stupid like current liabilities at the top, non-current assets at the bottom, you'll be fine. Don't worry about it. If there's a certain method your teachers taught you, by all means follow that, I would recommend. So current liabilities. So we had trade payables, which is in our balances. I'll just put trade pay, and 1/2 of that bank loan, you may remember from the additional information. So the trade payables, I'm just going to lift out of here, is 26,780, is that right? Yeah. And now just 1/2 of the bank loan, 1,225. I'll just show you that again. So I had the bank loan, 1/2 is a current liability, 1/2 is a non-current liability, so I just split it in half to get them two figures. And that's it for non-current liabilities. That comes to 28,005. So I'm now going to put my net, should I put my net current? I don't think I'm going to fit it on if I do that. I'm going to go straight onto non-current liabilities here, okay? Because I'm not going to be able to fit it all on. I don't want it to look all messy in a sense. But below current liabilities, you could put your net current liabilities, which is your current assets. No, your net current assets, which is your current assets minus your current liabilities, which it comes to 10,575. But I just don't have room for that, I'm afraid to say. Bank loan. If I was doing it on A4, I probably could fit it on, but unfortunately I don't have the space. So the other half of the bank loan is 1,225, and my net assets. How many lines am I? I'm going to need about 4. Okay, so my net assets, I'll have to put here, is going to come to 19,570. So that's my non-current assets minus my current assets. No, non-current assets add my current assets minus my current liabilities minus my non-current liabilities. So it's just assets minus liabilities. That's all it is really. So I need now my capital plus my profit minus my drawings to equal that 19,570. So capital, net profit from the income statement, and my drawings. See, it's still not going to fit on, which is quite disappointing, even though I missed out net current assets. So capital was 13,060. We adjusted that in working 8 when we introduced that £2,000 from our savings. Net profit on the income statement came to 36,440. On my drawings, we didn't change that in any way, 29,930. See, where am I going to go now? Underline that. It does come to 19,570 this. And that's it. A bit messy, but there it is. I know it's been a while since I last uploaded, but I'll try to get as much out as I can in late August and September and October. That's probably been the best time for me making videos. But if you have any issues, any questions, any recommendations for videos, anything you want to ask me, please email me. I'll put the email in the description below. But anyway, thanks for watching, and I'll see you in the next video.